we get $2,250 a month. Our mortgage on that is just less than $2,000. These aren't home run deals. We aren't cash flowing a ton. We're paying our expenses. One thing I would stress to the listeners is, listen, you're not going to hit a home run on your first deal. So there's a lot of kind of paralysis by analysis, I'm sure, with a lot of people that listen to podcasts and, are thinking about real estate. Like, at some point, you just gotta do it.
Welcome to the Real Estate and Financial Independence Podcast. My name is Chad Carson. You can also call me Coach, and this is a show all about investing in real estate, achieving financial independence, and doing more of what matters. Thank you for being here today. Whether you're a brand new listener or a long-time listener, I always appreciate you being here for another episode. The topic of today's episode is how a guy with a full-time job invests in rentals long distance from California. This is an interview with Travis Dodge. He is a student of mine, has been a TA in my real estate deal school course, also did a mastermind with him where I got to coach him a little bit more closely a year ago, and has just done a phenomenal job. He's just got to give him a lot of credit for what he's done investing long distance in rentals. He lives in Oakland, California, in the Bay Area, and he's got a couple properties there. He also has started investing across the country in Chattanooga, Tennessee. And so we talk about that journey. We talk about the frustrations. He had some back and forth. He tried out other markets that didn't work. And we just talk about the team he built. We talk about how he found deals, how he financed them, why he got into real estate, how he finds the time to do it with a full-time job and a family. And so none of that's easy. I know a lot of you are working a full-time job and trying to invest on the side and do it long distance. So whether you're investing locally or long distance, a lot of these principles that we talk about today will apply to you. He started 2 years ago investing and has now gotten up to several properties and has rental income coming in and is building wealth. So I think you'll really appreciate the details that we go into of Travis's story. Before we get started with the main topic, I want to remind you that if you're new here, be sure to hit the subscribe button on your favorite podcast player so you don't miss anything. I have new episodes that come out every Monday morning. Also, each week I include show notes for each episode. And in fact, in this week, I have a full interview with Travis and pictures from him and his properties. And so if you want to see those, there's a link to that article in the show description, so the podcast description, or if you're watching on YouTube, in the video description below. Finally, if you like the show, we always appreciate your support by leaving a review on Apple Podcasts. And as a way of saying thank you to those of you who already left a review, I give away a copy of my book, Retire Early with Real Estate, each week to one person who's already left a review. Please keep listening to the end of the episode for this week's winner. Now let's get started with today's interview with Travis Dodge. Hey, Travis, welcome to the podcast. Great to have you here.
Hey, Chad. Good to be here. Thank you.
Yeah, so I've been looking forward to this. I've known you for, I guess it's about a year and a half or so. But we've gotten to know each other through the process of me helping you and kind of being a co-pilot with you on your own real estate investing journey. And I love to unpack that. I want to share with people the fact that you've been doing this for 2 years.
Yeah.
And you kind of started from scratch and you had to move forward. I think that's gonna be very helpful for people. But I want to kind of start from where you are right now and just talk about kind of just like a snapshot of what your investing looks like, what your job is right now, and where you live, and then I'll kind of dig into how you got there as well, if you don't mind. Tell me a little bit of your story.
Yeah, so I'm 42 years old. I live here in Oakland, California. I'm a full-time freight broker, right? So I've got a full-time job that provides most of my income. Real estate's something I do very part-time. I started off investing in mostly stocks and index funds in the late 2000s. Mm-hmm. And I was kind of a late starter. I mean, I didn't get started until my late 20s buying index funds. And I kind of nerded out on some personal finance principles and budgeting, stuff during my late 20s and 30s. And I kind of always had in the back of my mind that I wanted to invest in real estate. I wanted to help complement, stock investing. I didn't make a lot of money. I didn't make a lot of money in my late 20s and 30s. The Bay Area is expensive. So I was able to chip away a little bit at, some of my index funds contributions. I'd invest $5,000 to $7,000 a year. Um, Forward a few years and I'm starting to make a little bit more money. And the idea of investing in real estate started to sound more real to me. Um, Fast forward to 42, I have, 5 properties in Chattanooga, Tennessee. I have 2 properties here in the Bay Area, a town called Vallejo, California, which is about 20 minutes north of Oakland. It's much cheaper, or was much cheaper than kind of this immediate areas of Oakland and San Francisco, but you can get really good rents. So that's where I am right now. I'm just kind of managing my properties in Tennessee, and I'm still in growth mode. I'm looking to continue to acquire properties. We'll talk more about this later, but the biggest challenge for me right now is really it's finding deals. Yeah. I don't do this during the day. I'm not a flipper. I don't, I'm not a real estate agent. So I'm not exposed to a lot of deals like, somebody that might do this every day. And so, that's where I am.
Great. Well, I want to go into each of those different kind of places you went to. I want to look at your Vallejo investments, your Chattanooga, and kind of get into those stories. I want to go take a step back. This is something just preparing for this interview that was interesting for me to hear you talk about, that when you were like late 20s, you mentioned in your written interview, which I'll have a link to your written interview in the podcast description, but you mentioned that like even in your late 20s, you really didn't have any access to, or had not really dug into financial education. You know, you had some debt kind of living, didn't have a lot of savings. I'm just curious for those of, other people probably in a similar situation, like what was the switch for you that said, wow, I actually need to start paying attention to this stuff, or did you get interested in it? Like, I'm just curious what that switch was for you.
Yeah, So I've since been remarried, but my ex-wife was a little bit older than me, and we lived in San Francisco, and she did really well financially. She had a really good job, and she was really into having clean finances, investing, saving, etc. And a lot of my friends, it's the late 2000s, they're in their 20s, they've got really good jobs, they're buying houses. And so really that was the motivation. I had to clean up, I wasn't making money. I'd spend more than I made. I was in debt. There's a lot of shame that goes along with that. There's, times where I would overdraft and, have to pay these, 5 overdraft fees to Wells Fargo at $25. And I'm on the phone, the next Monday, Tuesday with a rep in Wells Fargo. So I had no choice. And so I was kind of desperate, really. And I remember I bought the book Personal Finance for Dummies. Yeah. I didn't know anything about budgeting. I didn't know anything about stocks, index funds, real estate, nothing. Investing was just a foreign idea. And so I read that book, and I just, I'm kind of an obsessive compulsive personality. Once I really get into something, I really dive in. And so after that, I just, I started going down that path and read, a lot of personal finance books, and, was also exposed to other investors in real estate. I might have mentioned this in the questionnaire. I had a resident manager job. So I needed to find cheap living. Yeah. And I was just coming out of a divorce, and I applied to be a resident manager of a 33 unit apartment building in Oakland. And so for about a year there, I'm the on-site guy. Yeah. I have got zero handy ability, but what I was good at is leasing the properties. And there was quite a bit of turnover. They weren't the nicest units, so there was about a turnover once a month. And so I'd have to rent the units out, market them, interview tenants, show the property, respond to tenant requests, and then talk to the handyman. But I also got to cash the checks every month into the owner's bank account. And we're talking, 33 units in the Bay Area. This was in 2011. It was about $30,000 a month that I was depositing into this guy's account. So early on, I got exposed to the benefits of real estate, and it wasn't going in my pocket, but so that always was in the back of my mind. Like, God, one day I would love to, supplement my income. So that's to go back to your initial question. It was really kind of desperation. Like I had to change and figure out my finances.
Yeah. That's such a cool story that you were the resident manager, and what a light bulb when you see somebody else's money, $30,000 going through your fingertips. You're like, wow, somebody is putting $30,000 in the bank every single month. And a lot of people,
and I'll tell you, I live pretty close to that building, and I got to imagine they're getting far more rents than they were 10 years ago. Yeah. And it's not the nicest building, but it's in a really good neighborhood. Mm-hmm. And I've always thought, God, if this guy puts in a little bit more money in the building, paint it, kind of just clean it up a bit, like he could do so much better. And he actually lived in Florida, and he would fly out once a year or so. And I met him once, and I think he owned it since the 80s. And who knows, I'm sure he's refied a few times, but if he hadn't, I mean, the guy's got to be making some serious cash off of it.
I think we need to go send a letter to this guy, don't we? We need to go reconnect, Travis. I'm just thinking deal finding mode here. We got to go talk to him. Right. Yeah. All right. So interesting. So you had a moment where you're like, all right, I just got to clean this up. You read Personal Finance for Dummies, which was awesome. You just went to the basics, and you started, so what were some of the things like, and I always love going to first principles. Like, so personal finance, financial independence, you can make it more complicated than it needs to be. Like, what were some of the takeaways that now 10, 15 years later, you're like, all right, these were the things.
Think if you read any personal finance blogger, expert, they all kind of talk about the same principles, right? And it's real simple stuff. Spend less than you earn, right? Like, that's the basic. One of the ones that really resonated with me and helped me a lot is paying myself first, right? So anytime I get a check, have it automatically deposited into a certain percentage of index funds or cash reserves. So really just paying myself first. And, most people get a check, they spend everything and think they'll invest anything they have left over. And it's just not the case. And, the big fear of paying yourself first is, well, how am I going to have any left over? Or I'm going to go over, my budget. And it ends up typically working out where you invest a little bit and then you end up spending the rest of what you have. And so even though I wasn't making a lot of money, I used to take out, I'd say, large percentages for me. It wasn't a lot of money, but it was something. And so that was a big one. Pay myself first, spend less than I earn. Automation, so automating your finances, automating your bills, right? I'm not sending a check to somebody to pay my bill. I'm not manually paying my credit card every month. It's really just automating, having your payments set up automatically, automating your investing so it comes automatically out of your check. So those are the big three kind of principles that I took on, and the concept of low cost index funds too, right? I mean, if you're not reading about personal finance and you're not exposed to there's a little world of personal finance bloggers, and then you stocks and bonds and investing seems very foreign and only for people that have these great degrees and have been doing this for years, and that's just not the case. I mean, it's really not rocket science. So then an index fund is just a set of stocks that tracks a certain index. And, if I invest in, this index, I'll be fine and just let it sit and I'll be, 95% of money managers out there or whatever. So just the simplicity of investing also resonated. And, early on I was like, rah, drinking the Kool-Aid and telling everybody I could. People don't love to hear other people tell them about their finances and what they should do. So I, learned quickly just to keep that to myself, but yeah, it was, all that stuff was life-changing. And I still geek out on the stuff. I still read personal finance books and blogs and articles and to the point where I'm kind of thinking, let's kind of trend to a different subjects, and I feel like I've not mastered it, but got a good handle on things.
Yeah. You kind of immerse yourself in something. I'm the same way. Like you immerse yourself. It's like you jump in the deep end of the pool. You sink a little bit at first, but then, I remember the moment. I mean, I forget which books I read, but the concept, like in the Simple Path to Wealth of J.L. Collins, or just the fact that, hey, 95% of if you just do something simple, owning the entire stock market in an index fund, that's not only the simplest strategy, but it's also probably going to beat everybody else who people pay a lot of money to. And
totally.
that when you get a little nugget like that, that's mind blowing. And then you also, you get the habits. Like I was just, as you were telling me all those things, those personal finance first principles, it just reminds me of sports, and it reminds me of how behavioral finance is really the biggest challenge of just making sure you pay yourself first, and deal with your own personal psychology. And we all have our blocks, and so you just started figuring those things out.
Yeah, it's the behavior and the psychology behind it's so huge. And Dave Ramsey's, he's big into that behavioral side of things, and say what you want about him, and he's got some kind of extreme views on finance, but so what he does also works. So you were talking about something, gosh, I'm kind of blanking on what I was thinking. Anyway, I can't think of it.
No, but I really like to hear the foundation, because we talk about real estate a lot in this podcast, but the real estate exists in the universe, in the pool of finance and investing. And I think you and I share that quality of like diversification. You do some index fund investing. You kind of started with that, and then you got interested in real estate. I went the other way around. I always had real estate, and now I'm trying to expand my portfolio to have more real estate. I mean, more index funds. So it's a good place to be, to have both.
Yeah. You know what I was going to say, Chad? I know you're a big Warren Buffett guy, and I read Snowball, and I just love that book and highly recommend it. But, he, the greatest investor of all time, will say, hey, if you're an average Joe, and I consider myself an average Joe, invest in the S&P 500 low cost index fund, and you'll be fine. How simple is that? Right.
Yep. Yeah. He knows it takes a lot of work to be a professional investor. I mean, and so just, he tells all his heirs, if you inherit this money, put it in an S&P 500 index fund, and don't worry about it. Go do something else. Don't worry about it.
Exactly. And most personal finance, we'll call them gurus or whatever you want to call them, they'll say the same thing. Unless invest in low cost index funds, and you'll be fine.
Yeah. So we're on the same page there. But you were doing that. You kind of got that tug or that pull towards real estate. And I'm curious, was it the 33 checks per month thing? Was it something else? Like what kind of drew you to start wanting to do real estate investing as well as this other stuff?
There are three moments in my life where I was, introduced or exposed, or where it kind of planted the seed. One was one of those kind of, seminars back in the late 2000s, a kind of Kiyosaki, Tony Robbins type seminar that doesn't have a lot of substance. It was downtown San Francisco, and my ex-wife got me the tickets, and I didn't know anything about real estate or invest anything. And so I go to this seminar and sat in it for a day. And I remember sitting in this class, and it's kind of a fast talking guy in front talking about commercial real estate. It planted the seed, right? So I didn't get anything of substance. I didn't take action after this, but it made me think, this is what people that own commercial real estate, this is what they do. This is how they make money, and it's an opportunity to make money at some point. So planted the seed. I also had a short, unsuccessful, highlight that word, stint working for a commercial real estate broker in San Francisco. And this smaller firm focused on buyers and sellers of large apartment buildings. And a lot of these agents were doing really, really well. It was very cutthroat. The firm, pushed apartment ownership on the agents and encouraged it. So a lot of these agents also, they own buildings. And so for the short time I was there, I was exposed to not only agents that were owned and managed properties and did really well, but also apartment owners. And so I got the chance to tour buildings, talk to different apartment owners. And so there was that exposure there. I'm still not very good at my job. I'm not making very much money. But the exposure to that life, that opportunity kind of planted the seed. Became a resident manager a couple of years after that. And really, in the mid to late 2000s, I started listening to your podcast. And so I'm making more money. I've got an emergency fund. I've got a brokerage account with a fair amount of money in stocks. All right, let's check this real estate thing out. And the way I was introduced to you was by JD Roth, who plugged you in I think it was an article or something, maybe a tweet that led to an article. And I read his blog religiously. That was a big part of my development. And
he's like the OG of the personal finance blogging space. It's JD Roth. Get rich slowly. He's great.
Yeah. Sorry, I should give him a plug. I mean, he was huge for my development. He plugged you, so I started reading you. You came out with your podcast, and I would go on walks and listen to you and listen to Michael Blanc's apartment building investing podcast. And the more you listen to that stuff, the more it makes it like it could become real, And the great thing about you, Chad, is you have such a way of making it sound so simple, and hey, you don't have to go out and buy a 500 unit building, and you don't have to have all these degrees. Like, it's real simple. You do this, you do that. And so, not long after I started listening to your podcast, I called the agent I used to work for. Although I didn't do well, and he, I wasn't good, and I was a nervous wreck. I knew he was a really good agent. I knew he was an honest guy. I knew he was kind of a type A, like took his work very seriously, older guy. And so I called him and said, hey, I've got a little money. I'm looking to invest in some real estate. And, months later, we're in contract on my first property.
Like that. Wow. So you started with the agent who you knew, who he knew value in investing. And so you're like, all right. And so this is I think this is a good segue, because what I wanted to do, we started in the beginning talking about where you are now. You've got a few properties, or a couple properties in California near where you live, in Vallejo. You've got some properties in Chattanooga. So so what I'd like to do, when you've been involved in my kind of behind the scenes in my real estate deal school course, you've been involved in that. So we have a process there. And so what I'd like to do is just go through the process that I usually take students through to explain how you invested both in California and Chattanooga, just as a form of kind of asking you questions. So like the first step is like kind of ground zero, is like, what's your strategy in real estate? Because there's all sorts of strategies, right? You could be flipping houses, you could be short-term rentals, you could be long-term buy and hold, single family, multi-unit. Like talk about like how you landed on a particular strategy within real estate and particularly in the California properties you bought.
Sure. So, I all my places are either single family homes. I've got a couple townhouses, but they're, basically single family homes, right? I've got, as I mentioned before, I've got a day job that pays my bills. And so I wasn't looking to flip, which is, that's a job, looking to flip homes and wholesale. And for me, it was pretty simple. Like, hey, let's start off simple. Let's buy let's start off with one property, a single family home. Hopefully we can buy a good deal, and let's keep it for as long as possible. I come from, the heavily influenced by Buffett and Munger, buy great companies at a reasonable price, keep them forever, and different, stocks, real estate. I figured if I can buy properties at a decent price, and keep them forever, take good care of my tenants, take good care of the properties, then I at the end of the day, I'll have a little income. So that was kind of my philosophy. Like, let's go focus on one single family home at a time.
Right. And the important part here that I want to point out to everybody is that you have to find a strategy that fits your lifestyle and your temperament. So you have a full-time job, you're busy, you look at your personal balance sheet, you have strengths are I'm making money, I've got some investment, I got some basic investment know-how. Liabilities, I don't have any time, and I've got to so I got to figure out something that is an investment strategy that, yes, I'm going to put some time into it, but this is not going to be like full-time job going out and spending it. So you kind of backed into a strategy, particularly of calling your real estate agent. We're going to talk about deal finding here a little bit in a second, but you chose a location. So let's talk in all of real estate. One of the first steps is you got a strategy, but you got to choose a particular market. It's like you're going farming and you're going to plant your seeds in a certain soil. You live in Oakland. You chose Vallejo. Talk to me about Vallejo. Why you chose that? What the pluses were?
It was my agent. It was my agent. So I called him and I thought, hey, I'm going to invest in some 4-unit to 10-unit buildings in the immediate Oakland area. He said, this is what I would do if I was in your shoes. I really like the Vallejo market. Here's why. You could come up on cheaper homes out there that achieve solid rents and there's less competition. And so that was really it. I mean, I would try to keep it simple. I'm not the expert. So that's how I landed in Vallejo. And the more I started looking in Vallejo, it's a 20-minute drive for me. So I started driving the neighborhoods. I do a lot of driving for work. Anytime I pass Vallejo, I drive through a neighborhood. I still do that, So since then, when I bought these places about 2 years ago, and just the market everywhere in the country, it just seems like everything's high. But specifically Vallejo now, I'm like, oh man, these neighborhoods that I was looking at before and that I had my houses in, all of a sudden it's a little more unaffordable.
Yeah. So, yeah. Well, let's talk about the numbers. So, I mean, you chose we're going to, when we get to Chattanooga and your other market, we'll talk a little bit more depth because you went into a little bit more depth on that, but you trusted your expert and he behind the scenes, I think was looking at, California's and a lot of high price markets are a different animal. You've got to understand almost like the physics of what you're looking at there.
Yeah.
And, if you were to buy in the Bay Area, the rent to value, the value to rent ratio is going to be much worse than just a little bit outside of town. And so you went to Vallejo. Tell us about what were the price ranges of a single family house and what would the rent be, just kind of approximately?
Yeah. So we feel like we bought our property on the low side of the market. And granted, it was in tough shape. We bought ours for $315,000. In the Bay Area, as you know, that's a good price depending on what part of the Bay Area. We put some work into it, so we put down 25%. We ended up spending about $70,000 on our rehab, and believe me, that was a mistake. We did not pencil in $70,000 before we put an offer on the place. It's worked out, but I think we spent too much money on the rehab. We didn't plan the rehab enough. We added a bathroom. We redid the kitchen. We did new plumbing, new electrical. I've got a business partner. It's a childhood friend that he's incredibly handy. He's really good with his hands. He has very good resources. We had a good contractor. He was helping with the plumbing. He was helping with the electrical. He was there every day. Yeah. To the point where it kind of got a little uncomfortable because I wasn't contributing much other than money. So we ended up finishing. We rented the place. It's a 3-bedroom, 2-bath. It's kind of a bonus bedroom. It's listed as 2-1. We added the bathroom, but there's a third room that could absolutely be used as a third room. And so we get $2,400 in rent.
Okay.
No 1% rule there.
Yeah, not in California, not most high price markets. But you had about just under 400,000 in it, maybe 395 or so.
Yep.
And the rents were about 2,400.
Yep.
Okay.
Yep. So, I was doing the happy dance when I rented that place. I think I was happier when I leased it than when we closed it. And that's a big win. I think anytime you sign a new lease, it's a big win.
Celebrate. Absolutely.
Celebrate, you know?
Do you remember like rough numbers? And we don't have to get into like every single detail, but like, do you remember what the mortgage, taxes, and insurance were on that property, or something, just rough numbers?
Yeah. Yeah. So I know now because we've since refied and put money into our second rental. Gosh, I don't remember what I want to say it was in the 15s, taxes, insurance, and mortgage was in the 15s. It's now just less than 19. So since then, after we closed, we had all this money kind of tied up in this property after the rehab. And I'm just kind of, listening to your podcast, reading other stuff, hearing, what this BRRRR strategy, what is it? And it's kind of a different way of going about BRRRRing. We finance traditionally. We didn't expect to pull it out right away. And I was like, gosh, there's a lot of money tied up. We've improved the value. Let's refi. I didn't even know you had to wait 6 months. I didn't know anything about that. My broker was like, oh, well, you have to wait till this time. So after 6 months, we refied, took the money out, and immediately bought another single family home. We paid $385 for that. We get $2,250 a month. Our mortgage on that is just less than $2,000. Okay. So we're these aren't home run deals. We aren't cash flowing a ton. We're paying our expenses. These are long term. These are long term. They're good experience. And one thing I would stress to the listeners is, listen, you're not going to hit a home run on your first deal. So there's a lot of kind of paralysis by analysis, I'm sure, with a lot of people that listen to podcasts and are thinking about real estate. Like at some point, you just gotta do it.
Yep.
Yep.
Yeah, I agree. And I think it's interesting to look at we're going to talk about your Chattanooga numbers too, but you had these properties that if you listen to a lot of real estate investing podcasts, particularly in like the South and the Midwest, they're like, all right, you got to meet the 1% rule, which for people who hadn't heard that before, it means you want to try to buy a property that has a monthly rent that's about 1% of what you invest, your total price in the property. So for example, if he had $400,000 invested in that, for it to meet the 1% rule, he'd have to rent it for $4,000 per month. Or if he rented the property for $2,400, he needed to buy it for $240,000, which would be next to impossible in that kind of market. So it doesn't. What's the purpose of the 1% rule? It just is you kind of back into a property that makes a reasonable cash flow, usually about like a 6% or 7% cap rate. Or if you had no debt on the property, that's about what a property that meets the 1% rule would make, was about 6 or 7%. And then of course you're using some debt and some leverage. But I think it's instructive. Like, and one more question on your deals here. You bought them a couple of years ago. Like, do you know what they're worth today? Like, what's the price action done?
I do. Yeah. So the first place is around $395. Mm-hmm. Fifth Street in Vallejo. Well, I shouldn't give the address, but the second place is actually that's our. On paper, in terms of what its value is right now, that's kind of doing the best. So that's roughly $440. And the reason I know that is because the accounting software that we talked about, Chad, earlier, that it constantly updates and it's tied to Zillow. And, Zillow's not necessarily perfect, but it kind of gives you an idea. So you're looking at this dashboard and it tells you, here's your property is what they're worth. Here's how much you owe. So
right. Yeah. So so in 2 years, maybe let's just say 390, 395 is what you had in it. And then, it's gone up to 440. So you've had, 20,000 a year or so. Yeah. So kind of in price increase. So I'm kind of giving people rough numbers. A lot of people ask me about, hey, you're living in California, New York, Chicago or something, and you're investing in other areas, or even you're investing in your local market. The way you're making money on this property is you locked in a really low interest rate, so you're using leverage. Hopefully the rent is at least just paying your mortgage. Maybe you can eke out. I think when you start looking at long-term capital expenses and maintenance, you're probably just going to pay the bills, right? that's probably what you're doing. But that property, if you owned it free and clear without leverage, it would probably be like a 4%, 5%.
Yeah.
Is that about right? What you would think it would, it would be like
Yes.
a 4 or 5 cap rate is
Yep.
the way we look at it in real estate. And so if you make 4 or 5% from the income, without any debt, and then the appreciation, let's just say, is 3 to 5%, 5% per year, because if you're in a good market, you're making about a 10% total return without leverage on this single family house. And if you look at that, like over the big picture of investing, like that's solid. Like that's a really solid way to make money. The only difference between that market and maybe buying in rural South Carolina, where I am, for example, is that we're going to have a little bit more cash flow and a little bit less appreciation.
A lot more.
Yeah. So it's a different game. You're playing more of a, hey, I'm going to buy and hold this property. I'm going to use leverage, and I'm going to have a little bit less cash invested, but over time that cash is going to get a good return. But it's just knowing the game you're getting into up front, that you're not going to make a lot of cash flow from this property. In fact, you might feed it for a little while, but then 10 years from now, maybe you have a property that's worth, a whole lot more. Maybe it's worth 800,000 instead of 400,000. And that's very possible.
And it's really where you are in your life too. I mean, I'm not, the great thing is I don't use this money to pay my electric bill. I fortunately, I don't need the cash from my properties to pay my daily bills. I'm 42. I'm still in the growth stage. I'm still looking to acquire more properties. So I'm okay with less cash as long as I'm getting the appreciation. And then, in 10, 15 years, I may be having a different conversation about this property and its benefits, but
right. No, good. So you have a strategy there. You had a team member. A team is one of the things I was going to ask you about. You had a person who helped you find properties that you trusted. So there's a lot of pieces that went in there. You looked at your location. You got the money that you and your partner came up with the money. That's where you got your cash. You got long-term financing because you have good credit and a good job. You built a team. And then you went out and he helped you find the deal. Like it was just the real estate agent finding a deal. So you had a lot of these pieces without even, as a new investor, you just you went with it. You had those happen. So let's fast forward though. So you did a couple deals, and when I met you, kind of one of the big conversations was, all right, I got these 2 properties, but I'm a little interested in a different type of deal now. Maybe I can get something that has a little bit more cash flow. And that means I need to look long distance. I need to go somewhere else. So let's start with kind of the process you went through there of saying, all right, I'm in California. The whole country is open to me. I can invest anywhere. Like what did you start thinking in terms of where you should go from there?
Chattanooga fell in my lap, right? So in terms of selecting a market outside of California, Chattanooga fell in my lap. Now, before that, I knew I wanted to invest out of state. I knew I wanted to get, more cash on these deals. I wanted, smaller, quicker wins. I mean, the great thing about out of state properties is they're cheaper. They take less money of yours, versus California. I could get 3 houses in Tennessee or wherever, versus 1 in California. I was looking, as I was looking at Phoenix. I was looking at Salt Lake City. I briefly looked at Portland. And I went down that path. I started kind of forming my team specifically in Phoenix and realized quickly, 1, it's not that inexpensive. 2, I don't really love it. I didn't. And so I quickly pivoted to look at different markets. And, I think a lot of newbies that are looking at out of state investing, they get caught up in what market do I select? Like they're getting a tattoo or something. Like, man, focus on a couple for a few months, go down that path. If you don't like it, choose another market. And so that's, something I did. I ended up switching markets. Chattanooga fell in my lap because of our friend. And, the more I thought about Chattanooga, the more I liked it. And so, I bought those 2 townhomes off our friend RJ. And, since then I've we'll get more into the details and whatnot, but yeah, since then I've acquired a few more.
I want to go back to what you said. I've never heard that analogy, but I think it's perfect. So many people look at investing in a market like a tattoo, like it's permanent. Like I've got I've got to permanently invest here forever, or,
Yeah.
and I remember just working with you at that point. It was a struggle to look. There's almost too much choice. There's this paradox of choice that
Yeah.
I've got millions of different places I can invest,
Yeah.
or thousands.
Yeah.
Where do I choose? And what ultimately happened, you chose a few just based on, okay, my work is related to Phoenix. Let me just check that out.
Yeah.
Salt Lake, whatever the reason. And I tell people, like, sometimes the reason you choose a place can be random. Like, maybe you grew up there, maybe you went to college there, maybe you have a friend there. Like, it doesn't matter really. There's so many good places to invest. Start, just follow your nose a little bit.
Yeah.
And that's what you did. But then you pivoted, and that was a key moment. The other thing though was you put yourself out there, and it's kind of frustrating to be almost like you're floating around a little bit, but you put yourself out there, you started learning, and you started meeting people. And I think that, let's talk about that a little bit, because you ultimately found a deal, or you found a market because you met some other investors. You were in a mastermind group that I did. You could see the same thing with networking on Bigger Pockets, or being in a course, being in my real estate deal school course. You meet people, and you met some other people who invested in other markets. And that's ultimately how you heard about another market that was intriguing to you, right?
Yeah, exactly. I mean, met them, talked to them a lot about their properties, their market over the course of a weekend. And gosh, I don't know, a couple months later, RJ was looking to sell his places. And so, I mean, the big takeaway there in terms of networking is, I mean, it's so huge, knowing other investors, and networking such a critical part of I think real estate investing, and one I wish I did way more, because quite frankly, I don't do a lot of it at all. I network with my now team in Chattanooga. I'm constantly reaching out to them. I've met a few investors. I of course know you, but gosh, I mean, if I could even grow a bigger network, I think I would come across so many more opportunities.
Yeah, for sure. So you built a network. I want to talk about Chattanooga in particular. I'm a big fan of small cities. Like, I live near Greenville, South Carolina. I'm in a small college town of Clemson near Greenville. But talk to me. Chattanooga is a really interesting. It's in the South, which there's a lot of demographic movement to the South. There's it's in the kind of sunny, warmer winters. Tennessee in particular is doing pretty well. Talk to me about just that market. What appeals to you about it? Why it attracted you?
It's the South. It's a bigger. It's not a bigger city, but it's one of the bigger cities in Tennessee, and it's not Nashville, it's not Memphis. I feel like all the competition's buying in those two areas, and Chattanooga is kind of the sleepier city, but it's becoming really popular. Mm-hmm. Since I've been buying there, I've gotten to know it a lot more, and hear of people moving there all the time. I've had to rent 3 different places there. The other 2 had existing tenants, and I've had no issues renting the place, and I've actually achieved greater rents than I penciled in, which was really nice surprise. But I like it. We're flying out in September to go check out our properties, meet our agent, meet our property manager, et cetera.
Great. Talk to me about the numbers. So we're going to go back through the same process. We start with the target market. We then say, all right, within a target market, let's zoom in and figure out some criteria for what it means to have a good deal. We talked about Vallejo, what the good deal was there. What is a good deal for you in Chattanooga? What were the numbers you were hoping to achieve?
So in the areas of Chattanooga I've been looking in and own, so the first places I bought were townhouses, 2-bedroom, 2-bath for $135,000 each. Okay. Both of those are currently getting $1,275 in rent. My mortgage, insurance, and taxes is in the low 7s.
Okay. Got it. Right. So you have, let's say 50% of 1,275 would be about 600. So you're making in terms of cash flow, maybe above and beyond your mortgage is $500. There's some maintenance involved in there, some management. So maybe a couple $100, $100 or $200 a month, something like that.
Yeah. Yes.
Okay, great. And so and there's a lot we could say about criteria, right? But like going back to the 1% rule, it's just it's a rough rule of thumb. This is not what you ultimately buy a property on, in my recommendation. I like to run the numbers and look at all your expenses and everything you're going to spend: management, maintenance, taxes, insurance, capital expenses. You deduct that and you see what the bottom line is and how much cash flow you'll actually make. But just the rough rule of thumb is, hey, if you bought a property for $135, if you could have rent roughly around, $1,300 a month, or $1,350, you'd be about the 1% rule, and you're close. You're right near there. And but the other thing, real estate is about the numbers. It's about the cash flow. It's also about the quality of the location and how much growth that area is going to experience. So we've talked a little bit about Chattanooga and like long-term growth. You can run demographics on that and study it, but talk about the actual neighborhoods where you are. We always look at, is it A neighborhood where it's really hard to find a rental? Is it B? Is it C? Is it D? A little bit, tougher crime area?
They're B neighborhoods. They're B neighborhoods, mostly single family homes. It's kind of got a suburban feel to it, even though it's in Chattanooga. They're not blue collar. It's obviously not an A area. I just recently purchased, in March, we closed on these properties. All of them I paid $142,000. And I bought them as a deal from an investor. And it was kind of actually a perfect deal in that, they weren't attracting just normal home buyers because they were selling 4 properties, this investor, but it's also a little too small for, long-term sophisticated investors. So I kind of scooped up on these properties and bought them, about $20,000 each less than he was asking. So I paid I think I just said this, 142. And they're all single family homes, standalone, nice yards, big lots, 3-bedroom, 2-bath. The guy was an older investor, had owned the properties for a while and wasn't really keeping up the rents. The highest rent he was getting was about $875. We were able to bump one of those tenants from around that same number to 13. And she's a real estate agent, so she knows the market really well. She didn't want to move. I had one guy move out who'd been there about 25 years. We just recently got $1,550 for that one. And then I rented, one of the places came in vacant and I got 14 for that. So when when I bought these properties, it was the first time I really gotten into the numbers. I got your spreadsheet out and I'm probably looking too long at the numbers, plugging in different scenarios. And I felt I was very conservative in the rents I can get. I felt I was conservative in the amount of maintenance and rehab expenses I'd incur. And so far, knock on wood, things have been, I've gotten more income, in the rents, and then my rehab expenses came in less than I allocated.
Great. Yeah. And single family houses are, a different animal than multifamily too. Like if you can get a property I know the Chattanooga market a little bit now, but that meets about the 1% rule. It has a good long-term tenant, and the value. I'm not sure what you think the value of those are, but over time, those are tending to grow a little bit better than maybe an apartment unit would. Right. You've got a good growth machine there. Well, similar to your Vallejo properties, just at a lower price point. Sounds
right. Like. Yeah, I'm excited. I'm not looking to sell anytime soon. I'm looking to buy more. But I'm not counting on the appreciation in Chattanooga that I'm going to get in the Bay Area.
Right. Nope. Interesting. All right. So we've talked about your market, Chattanooga, criteria. How did you finance these? So I know the first one I touched on a little bit. You and your business partner put up the down payment, and then you refinanced it with the BRRRR strategy. How'd you finance these?
Traditionally, so I have a mortgage broker out there. And so our friend RJ introduced me to the mortgage broker who I used on my first 2 properties. Used the same mortgage broker, traditionally finance. I, put down 20% and mortgage rates right now are crazy. Mm-hmm. He did say after, now that I got 7 properties that I should expect that my interest rate will go up. Not because of the market, but because of me as a Lindy. So we'll see. But yeah.
It's a good point too, though. Like going back to the very beginning, we're talking about what are your strengths and weaknesses as an investor. You get into real estate, you're new, you don't know the market necessarily, but one of your biggest strengths, and I think a lot of people out there listening to this might have the same strength. If you're a full-time employee, you have good income, you have good credit, you can go get finance, you can get 30-year fixed financing. Yeah. And it's a lot easier for you to do that because you have a full-time job and you're not a full-time investor. Like even though I've been doing this for a long time, if I walk into a bank and I don't have the W-2 income, I'm making most of my income from investments, it just looks different to a traditional lender. It's not as attractive as somebody who has a normal salaried money.
Right.
So take advantage of that. That's what you did. You've got 7 mortgages here. And one long-term strategy, talking about buy and hold, if you can borrow money at 3 or 4%, and have, you're basically shorting the dollar. You're basically saying over the long run, I'm going to be paying back this money with dollars that are going to be cheaper than what I borrowed it at, and my property's going to be going up in value. My rent's going to be going up in value if you're in good locations. That's just a recipe for a really good wealth building over the long run. That's what you set up there.
Yeah.
So well done. And the final piece that I think people have a question about long-term for long distance is putting together a team. And I know that's not always a smooth process, but maybe talk to me a little bit about what your key team members are when you're investing across the country. How do you do that?
Gosh, it kind of makes me chuckle thinking about my current team. I'll tell you, I love my real estate agent. He's a local guy. When I first met him, he came so prepared to our Zoom meeting and knows the area very well. He's an investor himself. I really like him. I like my mortgage broker. Super important. You need a financing. By the time people hear this, I'll probably have a second property manager. And I think the property manager's got to be the most important piece to this puzzle. So I've had some frustrations the last couple months with my property manager, to say the least. And so, your team is so important when you're in long distance, right? And so you need a property manager that's responding quickly to the tenants, keeping you up to date, and maybe most importantly, turning the properties quickly, with good tenants. Yeah. And, admittedly, I'm not getting that right now from my property manager. So I'm looking, and I'm probably going to make a change pretty soon.
Which, kind of like your market when you had to pivot, is not the end of the world, And there are good people out there who just aren't good fits on teams, and that's part of the process. It's not the most fun part when you have to part ways, but I agree with you. Property manager is so critical. It's critical on my team too. I have a couple really good property managers, but it's once you establish that relationship, your property manager can help you obviously manage your property day to day. They can help you with future acquisitions, to estimate the rent, to help you remodel the property. I mean, that's a key especially when you're long distance, but for anybody who wants to be a little more passive, that's one of your top priorities.
Yeah. And it's going to be an uncomfortable conversation. I'm not, historically haven't been good with those types of conversation. The more, experience in business I get in real estate, the better I get. But you've got to manage the manager. You've got to manage your team, and it goes back to, real estate's just not passive. Yeah. So.
Especially where you've been the last 2 years. And I think that's a good segue as well. Like you've been working a full-time job. I know some of the hours you put in behind the scenes, just knowing the work you're putting in. What would somebody have to expect when they're getting the momentum of this new real estate business going? I mean, is this a 5-hour-a-week side gig, a 20-hour-a-week side gig? Like what is realistic for somebody to set aside?
If it's a side gig for you and you're not trying to flip, you're not trying to wholesale, you're not finding your own deals, 5, when you're buying a property, if, and you've got some rehab and you've got to lease the place, then, I would expect more. But you shouldn't, if you're just prospecting and you haven't bought anything yet, you're just looking, I can't imagine you'd spend more than 5.
Got it. So even you say it's not a passive thing, but you're spending 5. I've heard people spend 10, 15, they're doing a lot of work themselves, doing local stuff on the weekends or something. Yeah. But compare that to passive index investing. Yes, that's a lot more time. The thing I would add to that too, though, is like once you get your properties, you've been in acquisition mode, you've been in growth mode. I've also been in that mode, and I've also been in more passive kind of maintenance mode. It goes up and down. Like I have weeks where it's an hour, a half hour, especially now that I got property managers.
Yeah.
I've had other weeks when you're doing your tax return, that's, 3 or 4 hours, 5 hours. But I think it's good for people to be realistic. Real estate has its benefits, but it is a side hustle. Like it is something you have to spend a little bit of time on. You got to think about it. You got to run some numbers, but there's an advantage to that, which is it's entrepreneurial. It's you adding value to it. But if somebody wants to be completely passive, that's not their thing.
Right. And don't get me wrong. I don't regret the time I put in. I enjoy it. I think long-term. So I know the benefits are there. But I've got to put in a little work, and that's okay.
Yeah, you weren't afraid of it. You were prepared for it. But I think some people get into it not being prepared for it, or estimating they have more time than they really do, and that can be an obstacle for sure.
Where I get the most anxious in real estate is really during the turn. Mm-hmm. So the properties in Vallejo, I've written them pretty quickly, all things considered, about 2 weeks each one. But I remember thinking, gosh, I've got to drive there. I got to show the place. Am I ever going to rent this place? And it's a little anxiety provoking, but gosh, once you rent the place, especially single family homes, like I heard from one of my tenants the other day, for the first time since I rented the place to him a year and a half ago. I rarely hear from the other one. So if you have a property that, is well maintained, you have tenants that have some ownership in the place, they're responsible, they pay their bills. That's as passive as it's going to get, for real estate.
Yep. You get a kick out of this, Travis. You and I are both fans of Building Wealth One House at a Time, John Schaub, and I actually visited him and did a podcast with him. You might have heard, but I rode around with him and looked at his properties. And to your point of single family, he talked about he manages all his own properties there in Sarasota, 30-something properties, and he spends a few hours a week, 3 hours, something like that, 5 hours, and here he is, but and enjoys it and does it, but. I just thought of you with your own properties, and single family houses are a unique animal in the real estate world in that when you get a good tenant, they can stay for longer periods of time if you look for that kind of tenant and be happy with that. They like it that you're not selling this property. They like it that they can stay there and put some roots down. And they also, if a heating and air goes out or the roof is leaking, you need to fix it as a landlord, but they're also cutting their own grass. They're pretty self-sufficient. So it's one of the best, most passive parts of real estate is owning single family houses.
So when I was a resident manager, the reason I stopped doing it is because there was so much turnover. Different type of tenant mix, right? They're 1-bedroom house apartments in Oakland of a larger 33 unit building. Right. And there was a turnover at least every month. And so, I was a full-time professional then, and I was like, oh my God, I got to rent this place again. Like, and they weren't the most attractive units, so they take a little bit longer. And, the owner doesn't know this, but I also they seem like they'd be okay. It's like, God, I've had one person visit this place in a week. You start lowering your standards a little bit, which is just not good, right? Like, don't recommend that. Like, keep it vacant for a little bit longer. Find a good tenant that could pay their bills. And, it bit me in the tail once, but I had a turnover there all the time. And, so with these single family homes, it's just been really nice. Again, knock on wood. I might get a 30-day notice here pretty soon, but
but even when you do, my experience has been if you're in a good location, and that's the assumption here, because you've qualified your locations first, you're in B locations, C plus maybe. There are people lining up to live in those houses because there's not enough supply of rental houses in those neighborhoods, right? People want to live. People don't want to live in an apartment if they have a choice. If they could live in a house and for the same rent, they would absolutely live in a house. So my experience has been we get multiple applications. It's the easiest ones to rent. Yeah, that's probably what you found as well.
Yeah, absolutely. And when you introduced me to John Schaub, I was like, oh God, this resonates so much. And when you think real estate, when you get into real estate, you think big, and no, you could just keep it simple. You can get wealthy buying one house at a time.
No doubt. Well, this has been awesome. Like, we've gone in the weeds. We've kind of gone through the process of your evolution, where you bought, gone through the real estate deal school process. I want to as we kind of wrap up here, take a step back and kind of look at it from the big picture. As you look back over the last 2 years, you've put a lot of work in. What are some, I want to go over some of your challenges or some mistakes maybe, but also some of the things you think you're glad you did and maybe you could have done even more of. Like, let's start with maybe some of the either mistakes or just challenges, things that maybe other people need to be aware of when they're doing something similar.
Sometimes I can make a little bit more rash decisions. So, in terms of my property manager, I didn't feel like I had the time. I didn't want to spend a lot of time researching and interviewing property managers, even though I realize now, especially, that it's such a big deal. I would talk to multiple property managers, interview them, get a feel for them, talk to them about what they charge, what they do. My first property, which we've talked about, like, I didn't budget for 70,000 or, 70,000 for a rehab. I didn't. So talk to different contractors, figure out what you need to do. So just do a little bit more research, be more prepared. I think knowing your numbers is really important. I feel like over time I've gotten a lot better with the numbers, and the last 3 properties that I bought, I don't think it's a coincidence that I feel like those are my best deals. It's because I put more time into analyzing the numbers and figuring out whether or not it's a good deal, whether it's a bad deal. To make it a good deal, what do I need to offer? So just a little bit more preparation than what I've done in the past is, that's kind of the mistakes I've made. Now on the flip side of the coin, like, you also got to make decisions. You've got to make a decision. You got to move forward, and you can only be on the sidelines so long, right? You can only study so much, and you can only read so many books and listen to so many podcasts. So, I'm proud of myself for taking action, and Michael Blanc, or there's a couple podcasters out there that I've talked about the momentum you get after buying that first deal. You just focus on buying your first deal, and you buy that first deal, you get some experience, you get some confidence, and it opens up kind of the floodgates, if you will. And it's given me a lot of confidence.
Such a good point. Yeah. You got to get that first, you can learn as much as you can in a course, on a podcast, but then you learn like 10 times more on that first deal. Yeah. And so if you could just not make a big mistake on your first deal, just hit that single like you did. Yeah. I guess you had to come up with $70,000 between you and your partner. So if y'all had not had a lot of cash set aside, if you'd not had some reserves, that could have been ugly, right? But
absolutely.
That's why you do one deal at a time as well. That's what John Schaub says. You do one deal. You don't go buy 5 of those right off the bat. You do one. You're able to have some reserves. You're able to borrow a little money if you got to, and then you take a deep breath and you think about it, and then you refinance it and you do your second deal. And that's what you did. You learned a ton, and there's no surprise that your last 3 or 4 deals have been your best, because you're getting better and better. You're practicing. You're doing it, and that's the way we all get better.
Yeah.
So well done on that. I'm happy for you and impressed with the progress you've made, and excited to see where you're going from here. As I always ask at the end of the podcast, you're on the financial independence journey. You're making progress. People listening to this are going to be at all different stages, whether they're still in debt and they're just kind of digging their way out, or people all the way at the other end of the spectrum who are just investing their big net worth and trying to make some income. Yeah. What would you say are just a final tip to people who are on that journey to financial independence that might be helpful for them from something you've learned on your own journey?
And they haven't been into real estate, or they're not?
Let's just say financial in general. I mean, it could be, and I would say maybe a bit more of a beginner or somebody earlier on their trajectory. What would be some advice that you give them?
Patience. I'm trying to practice patience. I'm not getting rich off these properties anytime soon. I'm not getting financially independent on just my real estate portfolio anytime soon. I'm not, having to pay my bills with the income. I would say just practice patience, think long-term, work your plan, take action. You're good enough. You're smart enough. I struggle with confidence issues. I'm sure a lot of people listening to this, same thing. Oh, I'm not smart enough. I don't know much about money. There are a lot of real estate owners out there. I feel like they're a little bit more quirky than, established real estate investors. They're just more entrepreneurial, a little quirky. They're not rocket scientists, so take action. That's my big takeaway. Just take action and move forward.
Yep. Love it. Very good advice, and look forward to connecting with you and kind of keeping up with what your next steps are, Travis. Really impressed with what you're up to.
Yeah.
I didn't ask you this ahead of time, but after the call, if you have a social media platform or a LinkedIn link or something, you want people to connect with you, if you want to do deals with Travis in Chattanooga or something like that, or send deals, I'll definitely.
I'm looking for people to network with. I'm more than happy to partner with out-of-state investors, in-state investors on stuff. So I don't have any social media presence other than like my personal, email me. My emails, it's Travis, Travis, A as in Apple, Dodge, Dodge. So Travis A Dodge @gmail.com.
There we go. Simple. That's just like direct to the point. I like it.
Yeah. But Chad, I got to thank you. You've been the last year, you've been such a huge part of my investing and my growth. And even before we met each other, I read your book and listened to a lot of your podcasts, read a lot of your articles, and, you're such a great mentor for me. You break things down so simply. I know I can probably call you or email you if I have a question. Try not to abuse that. But you've been awesome for me. So I want to thank you.
Well, thank you. That's why I do this. I really appreciate that. And I get the benefit or the privilege of riding co-pilot with people like Travis who are hustling and making it happen and borrowing some of the ideas that I've been able to collect from other people. So it's a privilege. Thank you for saying that. And really excited to be able to share your story with everybody else. So thanks again for coming on, and we'll be in touch.
All right. Thanks, Chad. See you.
Thanks, Travis. See you.
Bye.
Thank you for listening to this episode of the podcast. You can find a link to today's show notes, which is actually a full interview with pictures and more details with Travis, who I interviewed today. You can find that in the podcast description below, or if you're watching on YouTube, in the video description on YouTube. If you're new here, please consider hitting that subscription button on your favorite podcast player or on YouTube so that you don't miss anything. I have a new episode on the podcast that comes out every Monday morning. This is also the time in the podcast when I give away a copy of my book, Retire Early with Real Estate, to one listener who recently left a review. This week's winner goes by the username Olivia Baker 13 on Apple Podcast. The review was left on May 13th, 2021, and it says like this: such a valuable real estate investing resource. If you're looking for actionable real estate tips, exploring passive income streams, or aspiring toward financial independence, hit the subscribe button. This podcast will be such a valuable resource for you. Chad is truly an awesome coach. Well, appreciate that, Olivia. Thank you so much for your kind words and for providing that review. Please send us an email at podcast@coachcarson.com, and I'll be happy for us to send you a copy of the book, Retire Early with Real Estate. Everything I've shared with you in this episode has been for general education purposes. I've not considered your specific situation or risks. Before buying your own investments, be sure to consult a financial, a real estate, and/or legal professional. Until next time, I'm Chad Carson. You can also call me Coach, and I'm your host for the Real Estate and Financial Independence podcast, which is all about helping you invest in real estate, achieve financial independence, and do more of what matters. See you next time.